Candlesticks in Forex trading. Candlesticks are essential for understanding price movements and help traders predict trends based on historical data. Candles make up charts. Each candle is a specific unit in time. Charting tools such as TradingView allow you to view candles for many time frames. You can look at a candle on the weekly, daily, 4-hour, 1-hour, 30 minutes, 15 minutes, 5 minutes, and so on. Each candlestick has two main parts, the body and the wicks, also called shadows. The body represents the range between the opening and closing prices. If the candle is green or white, the closing price is higher than the opening, indicating a bullish or upward trend. If it's red or black, the closing price is lower than the opening, showing a bearish or downward trend. The thin lines, or wicks, extend from the top and bottom of the body, represent the highest and lowest prices during that period. This basic anatomy is crucial to understanding any candlestick pattern. There are two primary types of candlesticks, bullish and bearish. Bullish candles, usually colored green or white, show that the price closed higher than it opened, indicating buying pressure. Bearish candles, which are often red or black, show that the price closed lower than it opened, suggesting selling pressure. Beyond these two types, there are also unique candlestick patterns like doji, hammer, shooting star, and spinning top, each with its own significance. Here, we'll cover some single candlestick patterns that are frequently used. First is the doji, which occurs when the opening and closing prices are nearly equal, indicating market indecision. Then we have the hammer, with a small body and long lower wick, often appearing at the bottom of a downtrend, suggesting a potential reversal. The shooting star is the opposite, a small body with a long upper wick, often found at the peak of an uptrend, hinting at a possible reversal. These patterns can reveal much about market sentiment. Now let's look at some advanced patterns that involve multiple candlesticks. The engulfing pattern occurs when a large candlestick fully engulfs the previous one, signaling a strong potential reversal. A bullish engulfing forms after a downtrend, and a bearish engulfing appears after an uptrend. Next, the morning star and evening star are three candle patterns that mark potential trend reversals, often after significant market moves. Lastly, the harami pattern involves a smaller candle within a larger one, indicating possible indecision and potential reversal. Recognizing these patterns can help traders anticipate market shifts. That's Candlestick in Forex trading. Thank you for watching. Stay awesome and keep tuning in. See you in the next video.